I guess you guys are like still in the early stage, so you can come up with ideas if you find a problem that is interesting. So I'll just explain what the space is, how various things are done, and you can ask me questions about various things based on how we go. And yeah, let's take it like that. So in this talk, we'll be first talking about what are derivatives and why do they matter. And then we'll be talking about three kinds of derivatives: perpetual futures, options, and finally something called squeeze, which was created in crypto itself. And yeah, so the first thing is like, what is a derivative? So a derivative is something that derives value from an underlying asset. So for example, like, a derivative of ETH, it can be something that has the same value of ETH. That can be a derivative. And then you'll be like, why not be the same thing as ETH? It's not the same thing. It derives value from it. It is a separately trading thing. So it doesn't have the same price. It tries to match the same price. So you can have a derivative, like any function, you can make a derivative, right? Like let's say there is x square plus 1. So you can make a derivative like, ETH square plus 1. That is a new derivative. Like it's essentially like what a derivative is. And so there are like, you don't want to make any random function into a derivative and trade it because people are not that insane in crypto yet. So we, I guess, yeah. So this I saw it. A funny slide. So like, people securitize weather, like you can trade weather sometimes. And, people write equations and all the equations are now getting traded. And yeah, so most people trade stuff like this and nobody knows what it means. People lose money and then they're like, oh, now I know why I lost money, and nobody knows still then why they lost money. And yeah, so there are unusual usage of Greek letters from alpha, delta, gamma, so many things. Yeah, and then yeah, so like most of the derivatives look like that, and then most of the derivatives are like, hello, I would like to buy some corn next month. That's kind of what a futures contract is. You're buying something for the next month. Yeah, so like let's see why they matter. So they can be so for any good market, you need like good stable derivative markets. So for example, most of the time people get very speculative, especially in crypto. And what happens is the prices go unreasonably high. Then what you want to do, what people as an informed market participants want to bring the price down. So you need places where you can short the asset. That's one of the things you can do with the derivative. You cannot short an asset. Everybody knows what is shorting. Yeah, okay. And then you can leverage. So essentially you have $100 and you want to trade for $1,000. So you can leverage saying that give me $1,000. I have $100. I will take a loss of maximum $100. Like you assume you have $100 in margin and then you trade. I'll explain more in detail. And then finally it's for speculation, aping into random stuff and then like, losing money. And yeah, so most of the people just lose money. Yeah, but this I copied from last minute, so it is very big. So the main thing is like derivatives market is 500 trillion in the normal market, and which is 6 times higher than the global GDP. So it's very big in size. And the thing is, in crypto, the total DeFi is 220 billion, and then crypto derivatives are like, for example, option is a type of derivative. It's less than like 1 billion. So the opportunity is there, and the main thing is like a lot of the things which you do on the traditional finance you cannot do on chain, right? You cannot, like some things are very difficult, right? Like building an order book is difficult. A lot of things are difficult. So there is a massive opportunity there. If anybody of you want to try and build something over there, it's an interesting place. Yeah, so let's talk about 3 types of derivatives: perpetual futures, options, and squeeze. So the first thing we'll be talking about is perps or perpetual futures. So this is a financial instrument which is mostly only on crypto, and the idea of perpetual future is, so you have an asset, let's say ETH, and your perpetual future will have almost the same price as ETH. And then the idea is that this thing which you trade will try to be the same price as ETH. Okay, and if it doesn't make sense, it will make sense in the future. So this is ETH perp. This is a screenshot I took from FTX, which is the biggest perpetual futures market. So you can see like in 24 hours, like around $3 million got traded of ETH. Yeah. So last year, one fun fact is like Bitcoin perpetual futures was traded more than Bitcoin. So it's a big thing, and a lot of people like trade on using it. So the idea is that there is another asset which is kind of follows the same price as ETH. So let's say ETH price is somewhere like this and this particular futures thing tries to match the same price. It's kind of the idea. And let's like try to understand how this works. So firstly, there is something called index price. So index price is something which is the actual price of ETH in some other exchange or something. So it's this particular derivative is trying to make the price same as this thing, right? So if you look at the current price, it's 1581 and the actual price is 1579. So there is a small difference, right? So the purpose is you want to make the difference as small as possible, right? And how do you do that? Some people are longing, which is basically like buying the asset, and there are some people shorting, which is like selling before buying. And so these people pay each other the difference, right? And this difference is called funding, and the rate at which it happens is called funding rate. So this is the funding rate, 0.03. Okay, does that make sense? So what happens is that so there is an index price and there is a mark price, and they pay each other something called funding rate, and everybody trades using something called a margin. Margin is the amount, maximum capital you can use, right? Yeah, so let's take a real world example. So let's say there is like you have a thermometer, right? And this is the actual temperature and this is the desired temperature. So you turn on the AC to decrease the temperature or turn it off or something. So this particular thing, which is the actual thing, that is a mark price, right? And the price that it is at the moment, it should be is the index price. So it is taken from other exchanges, platforms, oracles, I guess, okay, oracles and other stuff, and then these people pay each other this thing. So funding is the amount you pay from the mark price, is the difference between the mark price and the difference, and the index price, and it's paid per day. And when the number is long, then the short people pay long. So that was kind of very whatever. Yeah, let's talk about why you need this thing, right? It is very technical and it was kind of boring. So the first thing is leverage, right? So the first thing you want to do is when you trade something, you want to, if you're right, you don't have a lot of money, but you want to trade with leverage. So for example, you have $100, right? And you want to trade, you think ETH is going to go up. And you are saying that I am so sure it is going to go up. I am willing to bet everything I have. So what you can do is you can leverage by 10x. And what happens in this case is if your $100 will be equivalent to $1,000, and if let's say it goes up by 10%, then your 10% of this is $1,100, right? And you made $100 profit, which is you doubled your capital. But let's say this goes to $900. Right? Then what happens in this case is you only had $100. So you lost the $100 which you had. So at this point, you reach something called liquidation and you lose all your money. Right? So it's your maximum loss is the capital initially you had, and then you can leverage up to that much, and then you can trade for whatever amount. So why people use it is mostly capital efficiency, right? Not a lot of people trade 10x. In crypto, you can trade 100x, but you lose your money or get double the money in 1 second. Some people do it for gambling and other things. You can also try it. It's good. Yeah. So and other thing. So leverage is one of the most important things, right? And then the other thing is shorting, right? You cannot short an asset in the current mechanism. So what you want to do is you want to bet that the price will go down, right? So it's a speculative market. A lot of the times things are going up for no reason and you want to short it. And that happens a lot, right? And so shorting is also there. For example, there was a Terra crash, right? So a lot of people shorted UST. So they knew that UST will not go above $1. So it is always fixed at $1. So people 20x leveraged and shorted because you will never reach more than $1. So you can just put $1 million and get the exposure of $10 million and short it, and you will make the 10 times the money you put. So you can do various things with derivatives, and it's good for market to reach an equilibrium much faster. So this is perp, and yeah, so this is a chart of funding rate, right? The pay, what the amount that the longs pay shorts, which I talked about. Yeah, so this is what is it trying to do is it's trying to reach the equilibrium, right? The actual price of the thing. So you can see that historically in the market, most of the time, people are bullish about the market, and people who are shorting are like, very less, and the shorting, it's like very small duration. If you take the area under the curve, you will see like how much you are making. So yeah, this is a screenshot from another platform. So here, like, you can see like this is a nice UI. So you can see like 63% of the people are longing at this time, and 37% are like shorting at this time. So what you can do is you can have an asset. Let's say you have ETH, right? You have ETH, and then you go to this platform and short ETH, right? What your net, you don't have any ETH, right? You are putting it there and you're shorting it. So your net is 0. So what in this case, this is what you call as a delta neutral position. Has anyone heard this term before? So, yeah, it's a delta neutral position. So essentially, like, delta is basically rate of change of something with respect to the other, with respect to time. So since it's ETH perp, which is exactly equal to ETH's price, so delta is, rate of change of ETH respect to ETH. So it's 1, right? And so, yeah, so it's delta neutral. So so like you're shorting, so your net delta is negative, and normal spot position you have a delta positive. So I guess it's a bit trickier, but yeah, it doesn't. It's not very important how the technical details are. So essentially, what you do is you take $300, and then $150 you hold ETH, right? And then you short $150 of ETH. And in this case, the only thing that matters is funding rate, right? So you collect funding rate for free. Like if it's positive, you make money. If it's negative, you lose money. But as you have seen historically, most of the time it's positive. So that is kind of what basis trading is. Like you're kind of having a neutral strategy where you don't have a position and then you make money. This is one of the things that we have been doing. Like basis trading is one of the strategies. So yeah, so like the thing is like why you need something like this is for a good market, the funding rate should be very low, right? Like you are trading, you want to trade the almost the same asset. So like when there are more people doing basis trading and stuff, the market will have more liquidity, which just means that it is much better to trade over there, right? And then things that are which has more liquidity will get more volume. I think that is the, about perp. You have any questions? Yeah.
Because if both of the if the Ethereum the commodity that we're trading is tracking the price of Ethereum, if there is not a lot of difference, then why will people trade, right?
So if you are trading something and you have to pay the other person more, let's take an example, right?
Yeah.
I need a yeah. So let's say it's $3,000. Okay, $300. ETH is $300. Okay. Yeah. Yeah. So let's say it is $300, right? And the perp is trading at 298, right? So you need to pay like $2 every 8 hours, which is the funding period, right? So let's say this gap is very high. Let's take another situation where it's like 290, which is like you need to pay $10, right? So you are, let's say, a person who's longing this thing, like you are expecting it to go up. So you are essentially paying like a $2 over here, and here you pay $10 over here. Apart from the capital you are giving, why would you want to waste extra money, right?
Okay. You want
it to be
less.
almost same price as ETH, right?
Got it. If we are going long, right? If we are staying short, then we want volatility.
Yeah, but if there is a lot of short applicable, it's a market, right? People will just come and take it.
Correct.
And try to take the funding rate. It's almost free money, right? Like you are, if the funding rate, if the difference is too high, people will just short it and hold it somewhere and then just take money.
Got it.
It's like 10-20% typically, but when the gap increases, you make a lot more money. Any other question? What did you say?
So do you do just basis trading or funding rate arbitrage also in Polynomial?
We currently are like working on basis trading. We didn't like launch it yet, but we do normal basis trading on synthetics.
Any more questions?
Since you're trying to like stick to an index price, you could get, so could you like theoretically run perpetual futures on any tracker? Like you could have perpetuals on Apple stocks also, right? Since all
Yeah,
you're
but
trying to
you will
do
go
is,
to jail.
I'm sorry.
Yeah, but you will go to jail.
Okay, yeah, I mean that's a different issue, but it's theoretically possible, right?
Yes, you can track price on anything. You can, I don't know, track the price of what is the most absurd thing? Yeah, car prices, and you can track it, and then you can do whatever. Or you can track the price of chole bhature in a shop, and then you can make a perpetual future. But the thing is, like, you want liquidity, right?
Right.
That's the most important thing, right? Like, if there is only one person longing, and nobody like, you need large amount of people in the thing, right? People always trade in the exchange or platform where there is more liquidity, and typically you don't have a lot of shit coins perpetual futures. You have like some medium level, like up to a certain level, like 3 months 4 months old coins, like you have perpetual futures on it. You can go on FTX and do it, and so most of the time it's very good to have this mechanism. There was this, you guys have heard of LuxRare? Yeah, so on LuxRare, like they had the staking mechanism where, like, if you had Lux, you could stake Lux and you used to get Lux, right? And what that means is, like, you guys know yield farming, right? Yeah, so it's basically yield farming with a single token, right? And so you deposit Lux, and then you will get certain amount of Lux and some ETH, right? The only issue for you here is Lux is a very fluctuating asset. It will like go up or go down at any random point, and you don't know what the hell will happen. What you could do in this case is you can go to FTX, you can deposit like $1,000 over here, and then go on FTX and like short the same $1,000 of Lux, right? You're net zero Lux, and you're just farming this thing, and which is like kind of almost like no risk, right? And you are like, this is kind of why like DeFi had very high yields in the beginning, and then like all these institutions started coming up with billions of dollars and started doing this thing and dumping on. Yeah, if you started farming normally without doing this, you lost a lot of money, but then there are more informed participants than you, then they will make more money. It's kind of how market works. Yeah, everything good? Okay, now let's go to options. Does anybody know what are options? What do you work on? Oh, that's nice. Okay. On which platform?
I was a high frequency trader at Goldman, so
Oh,
we
that's
used to do a
nice.
lot of these.
It's pretty good. Okay. Hello? Hello? Yeah. So there are two types of options, call option and put option. So the idea is a call. I guess you should just read it yourself. Okay, so you are basically telling a guy that I will buy this thing for this amount at this time, and you are paying a token amount. Simple example would be, let's say you're a rice farmer, and every year you sell rice at 25 rupees, and sometimes you're afraid there is flood. So there is a very rich guy in your town. He says, like, if you give me 1 rupees, I will buy it from you at 25 at any point. So that thing is a put option, and there should be a specific date. He will be like, okay, 31st of September or something after farming. What happens is there should be a certain date, and there should be a strike price. So he's telling like 25 is the price that he's willing to buy, and yeah, and then at that date, like if it's about 25, you will just go directly to the market and sell it. You don't really care about your option. And if it is under the price, then you go to that guy and you will get like two. Like if it goes to 20, you will get 4 rupees because you paid 1 rupee in the beginning. So the 1 rupee that you paid is the premium. So that is an important term. And the other thing is there is a certain date it happens, and there is something called the strike price, which is the price that it happens. So call is where you are betting something will go up, and put is something where you are betting something is going down. And there are two participants. One is a person who is buying, and the other person is selling. So the rich guy is the seller, and you are the one who's buying. So let's look at an example. So a 3000 strike on May 15. So what that means is, if there is ETH price on May 15 is $3,000. So if on May 15 the price of ETH is 2,900, what you can do is you can get $100 profit on May 15. And then if it is above 3,100, your option is not worth anything. So because it went above. So that makes sense. It's similar to the whole thing. So this is a call option. It's better to visualize and see how it is. So what you're doing is initially you're paying a certain amount, right? So let's say the price is $100. You guys have decided that I will buy the thing at $100. So under $100, you lose like the premium that you paid, and above that you get the money, right? And the opposite of that is if you are selling the option, what you do is you do like similar thing in the downwards. Like if it is above, you're above the certain price, you make a certain premium fixed, and if it is below it, you lose money. It's opposite of this graph. It's like two of them. One is this is a buyer, and this one is a seller. Okay. Okay. So like that was technical. Let's talk about why it's like cool, right? So the first thing is like you get control over delta. So delta means rate of change of something, right? So you can decide how your net position is. You can make it positive, you can make it negative. Positive means when ETH goes up, you make money. Negative means when ETH goes down, you lose money. Sorry, when ETH goes down, you make money. And then neutral means it doesn't matter what happens to the asset. You can take any asset. It's predictable, like it has a simple formula. It has a simple thing. And then finally, it's like very capital efficient. Like if you have like, you can get like 10x, 20x leverage with very less capital with options. But you need to be right in the way you guess it. And finally, like you can make any payoff. Like you can be like, I think something's price is going to be in this pattern. Then you can like buy a bunch of options and make it into any particular pattern. Like see this one, this is bats, like looks like a Batman. So you can make anything, right? And as long as you are right in the direction, you make money. And you don't need a lot of capital to do that also. That's the cool thing about option, right? And yeah, like I said, like delta is the rate of change of like options with respect to time, right? And so you can also say like delta is approximate probability of an event. So suppose the delta of an option is 0.1, so there is a 1% chance of it happening. Or like the delta is 0.5, you can say that there is a 50% chance of this happening, right? And 0.9 means there is a 90% of event that is happening. So like one of the things that we do is we sell weekly covered calls. So what that means is every week on Friday, we take, let's say ETH price is $3,000. We say like next Friday, we sell a call option on like $3,300. And what that means is this is mostly like has a 80% probability of not happening. If it doesn't happen, we collect like $100 every week. So this is the premium that we collect, and then we keep on doing it every week. So this is a covered call vault, and the idea is that you are betting on math basically, and you are betting on the direction of the market, right? So if you are in a market and then you say like the market is gonna go up, then you go in a covered call vault. Then you don't go in a covered call vault, and then if the market is gonna go up, you don't go in a put selling vault. So we had like two products up, and this is the covered call vault and this is the put selling vault. So it's risky because you are betting on the direction of the market. But the thing is, most people in crypto are insane and they want higher yields, and they don't want, if you give them like 2% return, nobody's going to use anything. And yeah, so it's more like, so this vault, if you're using, you're basically saying that it's not a bull market, and this one is mostly saying like not a bear market. And that's all we tell our users. We make it simple, and people will just come here, click a button, and then they deposit. And this is how the strategy works. Every week we select a strike price, and then we sell options, and then we do the same thing every week. It's quite simple. We automate it, and it's like done in a completely permissionless way, so we don't ever touch people's asset. I guess if you guys are also building in DeFi, audit your code. There are a lot of bugs and a lot of hacks. I think today there was 150 million one. Yeah, so yeah, and that's kind of it for options. Anybody has any questions on options? Yes, sir.
Is there a way I can do like if else thing? So I want to do like if news event happens, then do this.
Yes, sir. It is programmable money. You can do whatever you want.
No, but I don't want to write program for that. I'm just looking for no code options for that. That's it.
Yeah, but it's very hard to make no code options on chain at the moment because the base thing is not working. To be honest, there is no working option protocol at the moment. There is no exchange to trade options, which is completely on chain and decentralized. The closest one that is there is something called Lyra Finance, but options is still an open problem. Like if you can figure out how to solve options for crypto, it's worth, I don't know, 10, 20 billion. It's a big company. It's a huge market. Like options trade for trillions of dollars. And like it's been like 3 years, 4 years, people have been trying. Some of them even quit and started making other stuff. Yeah. First thing is crypto is so volatile, right? So when you price options based on the volatility. And crypto is firstly volatile. You cannot make a pool with option and the asset. Why? It's an option, right? It's not linear. What did you say? Yeah, that is a correct answer. So after August 10, it's worth nothing, right? So you will hold, let's say you are an LP, you put 10 million of option and 10 million of ETH. After August 10, you will have 0 ETH and you will have 100 million option, which is worth $0. And yeah, so another issue is multiple expiries, right? Let's say you want to make a pool. You have to make pool with every single expiration that exists. So typically there are like 10 expiries for ETH in a week. And what are you going to make? 10 different pools, and liquidity is screwed up. So you cannot make there also. You can try something like Uniswap V3, we tried, it doesn't work. And yeah, so there are many issues with options. Like it's very hard to make an exchange for options on chain. The one model that works is like they have a pool, and then from the pool, this is how Lyra Finance works. So a person goes and buys option. So this AMM gives the person the option back, and then they have a exposure to the asset, right? So they short it in a futures market or like short it somewhere else, and then they make the futures like the position like very. But the thing is like this thing's fees is too high. Like it's not comparable to anything traditional finance thing. It's like 10% fees, which is like unheard of. So it's an open problem. If anybody wants to try it. If anybody wants to, I don't know, want to try it long term, like we can hire you even.
A lot of protocols, especially for example, DYDX has moved to order book model, and on app chain like Cosmos, a lot of order book models have been tried lately. Do you feel that with an order book model coming in, we can have an easier way to build options over them once we
No.
have enough liquidity? No.
The thing is like even if you look at centralized exchanges for options, it doesn't work. The volume is 1 billion. Like when you take something like 1 billion is a lot of money, but when you take something like a financial market, which is approximately trillions of like 1 or 2 trillion, something like that, like 1 billion is not a big size. Order books also don't work because the inherent asset is so volatile. Like you will have an option, and most of the time it's like gambling. There is something called implied volatility, which is like what is the volatility the market expects. It's sometimes like 100%. And so you mean like most of the time people are just saying like it will go to 0 in 1 year. That's kind of what it means. Implied volatility is how much volatile it will be in 1 year. So it can double or go to 0, right? So there is, and also like DYDX is not really decentralized. It's kind of like a centralized. So they have their own server, and then they run on top of Starkware, and then they push. So it's a good model, but it's not really decentralized. But it's also fine. But they haven't made options yet. If you would have looked at it, like they have only futures.
Yeah, I saw that. I wanted to ask you that, but since you have already answered that, order book might not be the right answer. I wanted to ask that.
Yeah, order book may be the answer, but I don't know. Like if I knew, I would be making that.
All
It's
right.
it's a question about problems, right? Like if I knew the solutions, I would be already making it and doing it, right?
Yes.
So like what works, you have to figure out yourself, right? Like nobody's gonna tell you what is gonna work. I mean, you're trying to build something, so most of the time, like most people are idiots and just do whatever you think is right. Yeah. So yeah, on our platform, I think it was 17 or 18% or something on ETH, and on Bitcoin it was like 15 or 16. So it only worked because the market was bearish in the last few months, right? So covered call walls don't work when it is a bullish market. So if it had been a bullish market, people would be losing money. So it all depends on the market.
Any more questions, guys?
More questions?
So, like as you mentioned, that the liquidity in option trading for cryptocurrency is low because of the implied volatility. Because the cryptocurrencies are so volatile that the premium which users will have to pay, or the sellers, which the premium which sellers would demand,
Yeah, sellers get. Yeah.
would be very, very high. So can't the options be equated to, let's say, something under root of a cryptocurrency, so that the volatility becomes, that much less?
I didn't understand the question. So you're saying like fix the volatility.
Yeah. So like, for example, like Square ETH is like Ethereum Square. And
Yeah.
so basically, if we go with under root Ethereum and the change of price.
So under root Ethereum is essentially Uniswap position, Uniswap V2 position. So if you hold ETH and USD, right, it's root of ETH. It's the same price as that. So you can just put it in Uniswap, right?
Yeah. So but the option, the volatility in that case would be less than what only Ethereum position will be having.
Volatility depends on the asset, right? It doesn't depend on like how the asset is moving, right? So the implied volatility is something where like people are expecting. So there are two things, right? First thing is there is an actual asset, right? So the actual asset is ETH. Then there is a derivative. The derivative is ETH option, right? So both of them are freely traded assets, right? So just like the perp is a freely traded asset, option is also a freely traded asset. So all of them trade at a different price, right? What is going to happen on that expiry, nobody knows. It's a like, unless you are an astrologist or whatever, so you cannot guess what is going to happen, right? You're just expecting something to happen, right? Or it will be like, I have 100 million ETH and I don't want to get screwed when ETH goes to 5,000 or like $1,000. So I'll just buy a lot of put options saying, okay, if ETH goes under $1,000, I want to make sure like I don't lose more money. So that's why like people a lot of the time buy option. Okay, I think I lost the questions. So the final thing is like this trades at its own price and this trades at a different price. Both of them will be trading over at a different period of time. And in options case, options price decays over time. Like it's like in the beginning, let's say I am giving you an offer to buy ETH on at $3,000 tomorrow and let's say next month. Which one would I charge more money?
For the 1 month.
For the 1 month, right? So time also has value over here, right? So option contracts have value over time. So over time, it will like have more value, and there is a decay of time also. Like so, what we were doing in the covered call walls is like 1 week before. What happens is that time value starts decreasing a lot more fast. So what the covered call walls essentially doing is it's just something that collects the time value, right? And yeah,
got it.
It's not like we came up with it or anything. People have been doing it in traditional finance for a very long time. We just made it like decentralized, permissionless, all the things that, crypto is for. And so anyone can deposit, anyone can see what is happening, all those kind of things, like very transparent. Okay, so finally, let's talk about Squeeth. Squeeth was made by Open. Open was a team that was been working on options for 2-3 years, and then they realized it's too hard to make options on crypto. So they came up with a different derivative, and the derivative is E squared. So E squared is ETH squared, like its price is 2 times square of ETH. So if ETH goes up by $4, this thing goes up by $16. Simple, right? And the idea is to replicate what options were doing, right? This is a new derivative, right? This is also one thing you can think about, right? Like sometimes the solution is to come up with something new, something that doesn't exist at the moment. And so if you look at options, the best thing that options give you is dynamic leverage. Like you can put $100 and you can get the reward for like putting $10,000, like if you are in the right direction. So what you're getting is a leverage. Like if you're right, and every more time you are right, you make more money, right? That's the basic idea. Like if you are putting so this is how the options payoff is, right? This is like how it is. This is how a leverage is looking like, and Squeeth looks like this. This is the payoff of it. So it increases I don't think I need to explain like ETH square to you. And squeeze is a perpetual thing. So essentially, perpetual is something that goes on for a long time. And like perps, like perpetual futures, we talked in the same time. It uses funding rates. There's almost similar mechanism. And on perpetual futures, you have something called liquidation, which I explained like with the margin and all. In squeeze term, you don't need liquidation because it's a square of something, right? Just goes to zero. When it goes to zero, right? Like this is the graph, right? Like at one. Hope that makes sense. Yeah. And when you are on the other one, you go like this. So this is the 2x leverage, and this is the ETH square payoff. So if you are right, you make a lot of money. But the thing is like, not a lot of people are willing to short this asset. And what that means is, for any market, you need two sides of people, right? You need people who are willing to buy it and who are willing to sell it, right? Or longs or shorts. So in squeeze, you have people who are buying it have an extremely high advantage over people who are selling it. So they make sure that thing is managed using something called funding rate. And in squeeze case, the funding rate is always quite high. It's like 0.25, like that kind of range. Like if you look at the perpetual future, it was like 0.0001. Like it's like a very high, large number. But there is like advantages to it. Squeeze has been live for 4 or 5 months. I don't know if it works. It seems to be something people are trading. And yeah, so that's also something. I just wanted to show it because, like, you know, whatever crazy idea you have, like if it solves a similar problem, you can try it on crypto and people will trade it. This thing had approximately 200-300 million trading volume in like 7-8 months. Yeah, I guess that's it. That's my talk. You have any questions about squeeze? You have a question? Yeah.
It's not about squeeze, but I want to know the futures part of your gamma vaults.
Oh, you want to know about gamma vault?
Yeah, the futures part.
Okay.
Maybe even the options part. Why not?
Yeah. Okay. So we have this thing called gamma vault. The idea is that we wanted to make a vault that works in very volatile markets. The information is not public. Don't take it before we go live. Okay. So the idea is that so typically, like the gamma vault payoff looks like this. So the idea is that above, so there will be like a, let's say, a certain range, like plus minus 50. So if ETH goes above or below $50 in either direction, it makes profit. So that's the idea of the vault. Like it's good for volatile markets. We've been doing back testing. It's been like getting like good returns. And the idea is that we look at, let's say ETH price is $3,000. We just buy ETH like 10 options. And then this will have a delta. So that is like, let's say it is like 0.5 and there are 10 options. So your net delta is 5. And you want to have a net delta neutral position. So what you do is you short 5 ETH. So when you short something, the delta is -1. So if you hold one short position, it is -1. And if you hold like more than one minus short position, wait, let me explain. So delta is the rate of change of something, right? So you want to make sure like when ETH goes up, you want to like have a net. So you short like 5 ETH. So your net position is neutral. So you're delta neutral. And then because like ETH price goes up above a certain range, then you make profit. And then if it goes below also, you make profit. You make a loss over here because you are paying an amount for buying the option. That's kind of the way that we are doing. This is something that we came up with. And it's not live yet, but I think we'll go live like next week. So yeah, you can experiment with a lot of stuff. People will still use it, so that's very good. With real money, it's epic. Like if you make a normal financial sector, nobody will even touch your thing. They'll be like, get regulated. Yeah. Any other questions? You can ask me general questions about building product, all that stuff.
Any questions, guys? No more questions? Okay. Thank you so much, Gautham. Really appreciate your time.